So obviously a record-breaking earnings print for Apple. You're still short on the stock. Why?
So I think fundamentally we see a company where you're paying a premium valuation of 27 times earnings. I think when we first shorted it, it was trading for around 30 times earnings, and this is for a company that's going to do less revenue in 2024 than they did in 2022. And so we don't really think the risks of their 70 plus billion of China revenue and their potential antitrust risks around the services business and how they operate the App Store are reflected in that premium valuation.
You think Tim Cook's commentary on AI products is BS and it's not going to be an earnings driver?
It will be interesting to see if that can really drive a replacement cycle. I mean, you're seeing, I think, under the hood for the last 5 to 10 years, a replacement cycles lengthen. I don't know if either of you know what the new features were on the iPhone 15. I think
seems faster.
I think for a lot of people, it's the improvements are very much incremental and not necessarily worth spending $1,000 on unless your battery's dying. So we just see it as a single digit type grower going forward and not worth paying.
What's your fair value? Right now I have Apple at 184. What would be that point where all right, I'm going to exit this trade and maybe I just go along it?
I think for me, if it was trading at sort of a high teens multiple ahead of a potential AI replacement cycle, I think that would be compelling, but that's another 20 to 30% lower, I think.
You know what the 5 biggest buybacks in history are? Apple, 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 Apple.
That's right.
When does that start to change your narrative?
So we were actually long the stock 10 years ago or so when the cash on the balance sheet was a huge percentage of the market cap of the company. But I think today, yes, it's a large buyback, 110 billion, but it's like 4% of the market cap. I mean, yes, that's great, but
you want more?
I don't know if it can. Well, I just don't. When a stock is trading at 27, 30 times earnings, I don't know if a buyback is really going to move the needle, because just fundamentally, the earnings yield on the stock is less than a 10-year bond. So I don't see that as moving a 2.7 trillion market cap stock.
Does it pay to even rotate does it pay to even make this trade, or do you follow the approach of Warren Buffett? And we're coming up on his annual meeting. I mean, he is about a 6% holdover Apple shares, and there's just buy and hold it forever and just avoid dips in the stock?
Yeah, I don't think. I mean, for us, we run a long short portfolio where we're maybe making more trades than the average person might do, or it has to do. I think if you hold Apple long term, you're likely to make a positive return. I just think the risks are to the downside in the next year or two as they struggle in China. And we offset that short position with long positions in smaller cap companies that are going to grow more and are much cheaper and are mostly outside of the U.S., mostly in Japan actually.
If investors think about Apple as part of their portfolio as sort of a staple, a dividend driver rather than a hyperscaler, is that view of the stock more positive for you?
I think it is. It's more positive, but for me, I would prefer to own really any of the other, just compared to the other large cap tech stocks. I mean, most of them have much larger growth opportunities. We're long Meta, which now it dropped on the recent earnings report, but it trades at around 20 times earnings, and it has much larger growth prospects, we think, in the near future, and are obviously much farther ahead on AI than Apple.
You're also short Tesla, and just hearing how you lay out your investment case for Apple, you must be expecting Tesla shares to get cut in half? I mean, they're fundamentally wildly different companies, and Tesla no way is Apple.
Yeah, I think there's obviously huge differences in both companies, although they do share the same sort of China risk and loss of market share in China. And yes, I think Tesla, we're short Tesla as well. And again, these are short positions that are small, 1 to 2% positions for us. But yeah, we could easily see Tesla dropping 50%. At that point, it would still be trading at a sales multiple of 2 or 3 times.
What triggers that? Is it China, or is it just the U.S. EV market never comes to fruition?
With short positions with such a high valuation, I think you never know what can be the trigger. But a loss of market share as competitive car manufacturers come out with more and more EV models, and people realize that some of the promises about full self-driving and robo-taxis just always get pushed into the future. I think at any given moment that that can serve to kind of realize the gravitational pull of such a high valuation.
Is Musk's kowtowing to Xi Jinping something that could potentially be a growth area, particularly because 60% of EV sales do come out of China?
I mean, being beholden to what is essentially a dictator, I think, is always a risk for any business. And the higher the valuation of your company and the more dependent you are on China for your growth, I think the more at risk you are there of the political machinations in China.
I want to end really quickly on something you said about Meta, because their AI spend got dinged by the street. Why is it that their AI capex was negative?
Well, I mean, I think anytime a company is making a large capital investment, you have to wonder what the returns are going to be on that investment. But I think what Zuckerberg has proven over the past few years is that he can be trusted to make smart investments when they come along, and they're going to grow more than 20% this year. So we're willing to give him the benefit of the doubt that those are going to bear fruit over the near term.